Hey, what's going on, everybody? Okay, so it's gonna be my normal weekly update for you guys on the S&P 500 earnings, bond yield data, economic data, and the likes like that. All right, should be definitely a much quicker one here. Not much there to report on stock earnings updates for the week over for the S&P 500. And very little economic data also. Only had two reports that I'm going to talk about, and one would be the durable goods order update, and the other one would be new home sales. Also have some information in here about credit default rates update, so that will also be covered. Otherwise, it's just the usual stuff there as far as economic data is concerned, which would be the weekly jobless data, jobless claims data that I put up every week. Insider trading info, and also the and also a truckload freight rate data that you always see me talk about, and we'll talk about what's coming up next week or this coming week on the on economic data, right? Also, you're probably going to get a double dose of looking at my ugly face this week. So I have my own update coming here that you're watching now, and I did an interview with Jerry and Conan from Grow My Thrift Savings Plan the other day, and I believe they're planning on posting that this weekend. So I believe he usually does his updates on Sunday, so I would expect that to be on Sunday. I'm recording this Saturday. I expect to have it on my page by Saturday, and the groups as well by then. And as a reminder, if you're as you're watching on YouTube, if you want to skip ahead to any of the more interesting content to you, don't forget, look in the video description. There are bookmarks / chapters in there that you can always use to skip content that you're not interested in on this video, and can move ahead to content that is of interest to you. Okay, so that said, let's get to the data. Okay, guys, let's start with S&P 500 earnings data. This is the, for those of you guys who are new to my channel or videos, the S&P 500 is what the TSPC fund follows. If you're not a TSP participant, any index fund that follows the S&P 500, you can use this information to help you. This is, as a reminder, this is just these numbers here are based only on earnings alone. They don't factor in market sentiment or geopolitics or other stuff going on. That said, though, I'm going to kind of go through this as quickly as I can, so please pause the video in whatever spots you need if you need more time to watch to view these. Last week's updates, we only had about 10 companies report updates. I only got about a +5 effect on my current value on the trailing earnings. No change at all to the forward estimates or expected prices looking ahead, but the 12-month price target did drop by 5 points from 51.10 to 51.05, and the ideal trading range is also unchanged. 48.10 to 49.85 would be what I would call the normal trading range if we didn't have any concerns about recession right now. Last week's updates, I was expecting a +4 effect on the CV. We actually got +5, so that's good. I got 93% of the index now updated for the quarter. It's going to be a very slow week. I only have 30 companies reporting over the next 4 weeks. That's barely 6% of the index, and I do expect it to remain that slow for the next couple of weeks. Percent of the index that reported positive growth, it did tick up just slightly. We're still a little below the normal range, or the typical range of 60 to 70%. And stock earnings yield for the index, it actually ticked down 10 basis points from 2.54% to 2.44%. However, bond yields also dropped. 10-year bond yield went down 14 basis points from 382 to 368. So for that because of that, the recommended stock bond mix remains at 40% stock, 60% bonds. In other words, I'm predicting about a 60% chance of a recession within the next year. And looking at the 10-year versus 2-year bond yield curve, we had a negative 60. We are inverted by 69 basis points last week. We are now inverted by 74 basis points, which is even worse. And average long-term bond yields went down from 396 to 380. That is an indication that the bond market is expecting inflation to come down some more in the coming months. Okay, only two companies with $100+ billion market caps reported updates last week. Those would be Medtronic and Deere & Company. Tale of two different companies here as far as what they did. They both beat estimates or my previous expectations. However, their earnings are in two different directions, and their forward estimates were revised in two different directions as well. Deere & Company, they actually looked really good there. They had a really nice beat on earnings. Earnings are up large, and their estimate revisions are also up a very healthy amount. So I'm actually impressed with them. I think they're worth buying shares of right now. And a complete list of 10 companies that reported updates last week. Here you go. They're ranked by market cap, as you see there. Deere and Medtronic up at the top. Also had some others there, Analog Devices, Autodesk, HP, so a few tech stocks there, and then got Dollar Tree and Best Buy in there. Those are a couple of retail stocks. You can use, I was talking about Deere & Company. Their earnings are way up, $7.44 per share this most recent quarter versus $4.12 last year. And these estimates, like I mentioned, are all revised upward a fair amount. And they're actually looking at plus 28% almost EPS growth over the next year. Looking at momentum buys here. I got two stocks from last week that meet that screen there. I've got Deere & Company and Autodesk. Both of those have greater than 10% EPS growth expectations over the next year. And look at the Contrarian buys. We got two stocks as well that meet that screen from last week's updates. Got HP and Best Buy here. These are the ones that have minus 10% or greater or worse EPS performance expected over the next year. Now, when you see that, I expect the share price to perform even more poorly. And you might think that's a bad thing, but like I said, it's contrarian. This is meant for those of you guys who want a dollar cost average and be able to buy more shares of a stock that can probably turn the corner and do very well once either their industry cycles back into play or the broader economy starts doing better. And next week's updates, got about 9, I think it is, companies here. 2 of them have greater than $100 billion market caps, which I'll be covering next week. The largest of them being Salesforce, and the other one being Intuit. Both of them are tech stocks, basically. Salesforce is also a Dow Jones Industrial Average company, so if those of you guys who like to track the Dow stocks, that'll be one to also pay attention to. And looking at the bond yield here, I mentioned in the first slide there that the long-term bond yields came down some. That's on lowered inflation expectations over the coming months. So that's a good thing. That's one of the problems we're having right now is inflation being out of control. So that's a positive. However, there are concerns here. Got inversion going on here. Even the short-term bonds are up above the long-term bonds, and that's going to make things a lot more cost ineffective for banks when it comes to lending money to borrowers. Now, they tend to borrow money on themselves at this short end here, so they can seed the money, seed more loans here on the long end. But if it's not cost effective for them to do so, they're going to not borrow so much, and they won't be able to give out so much either. Also, a 30-day bond, or 1 month, as you see here. It's currently at 4.16%. And I mention always that I like to watch this one because it usually goes hand in hand with the Fed funds rate. What it usually does is tends to predict what the FFR is going to be in the near future. So it was in that 3.75 to 4% range recently, which is right in that neighborhood where the current FFR is at. It's actually getting above it now, so it's already starting to price in at least 0.25%, maybe even half a basis, 50 basis point rate hike on the next Fed meeting. Now the Fed did talk about, the Fed meeting minutes did come out. We'll talk about that a little bit later here. But generally, this kind of curve we don't like to see. That's very restrictive. However, the rates are not super high. They're elevated, but they're not super high. This would give me the impression that if we go into a recession at all, there's not such a likelihood that it'll be a very deep or a profound and very long recession like the two recessions that we saw in the 2000s were both two of the worst recessions or bear markets that the stock market has ever seen. And this is not giving me the impression that it's going to be that bad, if there even is one. All right, let's look at the economic data now, or other stuff there. Okay, we're going to start with the initial jobless claims data here. Still looking pretty stable there. Had 222,000 this week. Last week's number was revised upward just a tad from 225 to 226. However, this week's number was actually below that number, so that's actually looking pretty good. We're still seeing single-digit numbers here as far as the current level relative to the 4-week and 8-week averages. So mostly stable there in spite of the recent layoff announcements by Amazon and Meta and some other whoever else you might have seen info about. So again, we're not seeing anything really out of control. We saw worse in July, and that came back down. So some stability at least. And looking at the continuing jobless claims, this is one where we do want to pay attention to as well, because even though we got some stability on the initial claims side, the fact that this is creeping back up here to up above 1.5 million and actually getting up into these later March numbers is telling us that more people are not only losing their jobs and filing initial claims, but they're maybe taking longer to get rehired at other employers too. So it's an indication that the jobs market might be coming down a little bit more, and that there might not be as many jobs available to hire into now, or maybe they're being a little bit more selective about what opportunities exist that they're willing to jump into. It's starting to, it's at least shifting more into employers' market there as far as the who has better bargaining power. All right, this week there were only 2 economic reports that I'm going to cover that have strong impact. Those are the durable goods orders report and the new home sales report. Just kind of summarizing right now. Last month's report on the durable goods was up 0.3% month over month, and this month it was actually up 1%. That is more than twice what the consensus estimate was for 0.4%. And next month they're expecting 0.3%. And looking at new home sales in October, they were actually expecting a slight drop from 588,000, about 570,000 this month, but we actually got an increase up to 632,000. A little bit of a surprise there, I would say. Next month's forecast is for about 580,000 again. We'll go into a little bit more detail on those in a second here on the charts related to those. Also, the FOMC minutes, they revealed that the Fed is actually entertaining the idea of backing off on their rate hike policies. Not so hawkish. There's still a possibility they could increase the Fed funds rate another 75 basis points in December, but it's looking more, definitely more probable that they might go for 50 basis points, maybe even 25. I don't know, but definitely looking like a possibility of 50 at the very most. And looking at the consumer credit default report here, I believe this one came out the previous week, and I could have talked about it last week, but I missed this. Did not notice it until this week, so I'm going to cover it this week instead. Mostly looking fairly stable there still, actually. The bank card default rates did tick up, 8 basis points there from 238 to 246. However, it doesn't look very out of control at all there. And if you look at previous tendencies there, even in bull market periods there, we saw tendencies for it to be a little on the volatile side, where it shoots up and then comes back down, shoots up, comes back down, shoots up, comes back down, shoots up, comes back down. See what I mean there? So some volatility with the bank card defaults is to be expected. The trend right now is still well below what we've tended to see during that long bull market cycle, though. We're barely at 2.5%, and we were consistently up in the 3 to even over 4% range here. We got over 4% actually during the pandemic, the COVID-19 pandemic, but otherwise it's been a good chunk of time up above 13. Anywhere between 13 and 14 for the latter half of that last bull run cycle. Auto loan defaults are ticking up a bit there. There's a little bit of a concern there, but they're not quite up to where they tended to be during the bull run cycle there. You see here, it tended to stay right around 1%. And we're actually below that. We're barely in the 0.75% neighborhood right now. And mortgage defaults, surprisingly, as much as the housing market has been newer buyer, I would say, housing prices up high and mortgage rates up high, you're kind of inclined to think that we'd see more problems with mortgage defaults going on, but no, they're actually looking really good here. They're at long-term lows. Looks really good. Okay, let's parse through some of the details now on the durable goods orders. I'm going to try to get through this as quickly as I can so we don't make this video too long here for you. So I mentioned we had strong growth, 1% month over month. That's very strong. We hope to not see that on a consistent basis. Like I mentioned, want to try to see this in the 0.2 to 0.4 range, ideally positive. Strongest reading we've had since June of 2022, or 4 months, whatever. And breaking this down here a little bit more, the September result was revised downward just a little bit, and it was above forecast, like I'd mentioned before. Transportation equipment is up 2.1%. Military aircraft, this is where a large amount of it's coming from, is plus 21.7%. A very large amount. So basically a batch buy there is might explain why it was so high for the month. Hopefully it doesn't stick around, but yeah, and I doubt it will. Excluding transportation, was up 0.5%. Electrical equipment and appliances was up 0.4%. Machinery plus 1.5%. Capital goods plus 2.1%. Computers and related plus 4.7%. We've been seeing a trend with tech stocks where tendencies for tech stocks or sellers of electronics, particularly computer equipment, be struggling seemingly more lately. But this data here suggests that there's possibly a surge going on there, How much of that's related to just Black Friday and the holiday shopping season, that remains to be seen. But at least if it's for now, I would more likely chalk it up to holiday season. But we're gonna have to keep an eye on that one as time progresses to see if that continues that way. And non-defense capital goods, excluding aircraft, is up 0.7%. And that's kind of wraps up the durable goods orders. Let's move on to the new home sales data now. New home sales data here is we got 632,000 homes sold in October. That's a 7.5% increase month over month from the September number result of 588,000. That beat the forecast of 570,000. Breaking this down by regional, the South is up 16%. For a total of 399,000. So I talked about this last week, where a lot of the sales seem to be, a lot of the demand for real estate and homes and stuff seem to be focused on the South right now. And this does back that up. Northeast, that's up even more, but as a proportional basis to that 632,000, it's much smaller. Northeast is up 45.7%, very strong. However, it's only 51,000 sales in that area. So only 1/8 amount of sales in the Northeast as they're getting in the South. Midwest, that one is actually down more than 34%. That's actually down to 50,000, just a slight bit less than what the Northeast is getting in sales now. Median price is now at 493,000. The average sales price is at 544,000. And inventory, there are 470,000 homes still on available for sale. That is up 21.4% year over year, and that represents about 8.9 months of available homes based on the current sales rate. And a quick look at the insider sell versus buy data here, courtesy of whalewisdom.com. We are still looking kind of in the middle ground area, leaning a little bit more on the bullish side, but not in the bull territory yet. So that's promising there. Might have a little bit more, that might give a suggestion that we might see a little bit more gains from stocks this coming week. We'll have to keep watching that. And DAT truckload freight rate data. Mentioned here that the loads available are down a lot. It's going to cause that generally causes freight rates to drop through the floor. However, this week we're up actually 9.2% this week. November seems to be more on the flat side overall. If I recall, the first week of November I had reported that we were up on available loads, and then last week I want to say it was down, if I recall, but I'd have to go back through my previous videos. Up right now. Spot truck posts are also up. The strongest amount the biggest strength there on the loads is actually on reefer loads. Also got some pretty good strength out of van loads though, so that's a positive. However, it was also reported, and it's expected, that a lot of this is seasonal seasonally related due to Black Friday, holiday shopping, people having their Thanksgiving feasts and maybe prepping for other holiday festivities as well. So this is to be expected. Really want to see these kind of numbers after the holidays, but I don't think we're going to see that. And breaking down the freight rates, also from DAT, van and flatbed rates remained unchanged at 238 and 283 respectively. However, reefer inched up to 279. That's fourth week in a row that it's gone up, or third week in a row, whatever, after hitting a low in early November. And fuel prices, the average fuel price actually came down about 8 cents. I believe it's expected to drop some more this coming week, so I anticipate personally it dropping down into the 5-10 range or so. This is for diesel fuel, by the way, guys. So that should help some with the inflation concerns and kind of give a little bit more wiggle room, hopefully, for truckers to get more desirable rates, where we don't have so many problems with truckers going out of business because they can't make enough money. These are particularly the single truck operation businesses that where they need a larger amount of profit margin in order to remain in business. The more trucks you got, the less profit margin you really need to run a sustainable business. So we don't really want to see the trucking industry get pinched too much. Otherwise, that's going to translate more into additional problems there with unemployment data, economic problems, whatever. So we don't really want to see that capitulation going on there. And looking ahead to next week's data, it's going to be a pretty busy week here, as you might notice there. These are some of the important ones too that I really like to pay attention to. Don't mind this this Monday, December 5 ISM non-manufacturing. I will be talking about that one again next week. That's not until the following week anyway, so we're just going to focus on the Wednesday, Thursday, and Friday this week coming up. Wednesday, we got the ADP employment change data. It's actually forecasted to drop a little bit from 239 to 200,000, and next month it's expected to drop a little bit more, even to 198. Also, we're going to have the GDP growth rate second month reading, or second estimate. Last quarter, as you know, we were at minus 0.6% on the GDP. The first month reading was at actually at 2.6%. From what it looks like here, they're expecting 2.7% as of the second reading. Next quarter, they're expecting another 2.6%. So we're looking good there. We'll see how it goes, though. Job openings, JOLTS data here. That is actually, the consensus is for it to drop a little bit, and we kind of do need that to drop some. That'll help the inflation issue as well. Wage growth leads to inflation, so again, when the employers have more of the bargaining power, or at least when it's shifting more toward the employers, that can kind of help tighten up the inflation concern. More jobs is great, but like I mentioned, we got to get this inflation problem under control first. And Thursday, we're going to have personal spending and personal income data coming out. And then ISM manufacturing. That's a really important one that I pay real close attention to. I recommend you guys do the same. Now, a 50 reading is flat. Now, anything above 50, it represents expansion, and anything below 50 represents contraction. So the consensus right now is for us to go just a tad into contraction territory, but mostly flat. And the forecast for next month will also be flattish. So as long as we remain stable there, I'm okay. I don't want to see it start dropping down into the mid to lower 40s. That's much more concerning then. And Friday got unemployment rate that was 3.7% last month, and it's expected to remain at 3.7 over the next couple of months. And non-farm payrolls, that was at 261,000 last month. It's expected to drop to about 200K this month, and pick back up a bit to 210 next month. All right, let's take a look at the S&P futures chart here now. I like to look at S&P futures instead of S&P 500 price itself, because it gets data off of it. As you see here, we had a continuation of a rally there. It's actually good, but we're right up there on that 200-day moving average now. So better chance we're going to find some resistance here around this level. This is also on lighter volume, so it's that's more indication that I wouldn't really expect that we're going to find much much of an effort to get past that 200-day average. I would say there's a better chance we might come back down here a little bit. Whether we get down here into this 10-day average here and find support again, I don't know. I'd say it's more likely, though, we'll come back down here to the 100-day, which is the green line here. That is currently at the 39.26 level. And 200 days at 40.59. Now that I'm looking at this myself, I might have to sell off my futures contracts here as well, and wait for the price to drop and buy back in once it comes back down some. At least that's what I would anticipate possibly seeing there. And looking at the weekly chart, let's zoom in on this area here. Alright, so weekly chart looks a little bit more bullish there, but we are on the top. It looks like we're on the upper end of this short-term trend here, this short-term uptrend. So that could be, it could be more reason I think that there could be at least a short-term drop in the near future. But we do have a little more wiggle room here between the current price and the 100-day moving, 100-week average, which is up here at 41.46. All right, and let's look at the crude oil futures. As mentioned, crude oil price has a lot to do with why gas prices are so high, and gas prices being so high have a lot to do with why inflation is so high. So I'm going to continue to watch this as long as inflation remains a hotbed issue. Price is down here, actually. It actually came down to $76 a barrel at the end of the week. Getting a short-term low spot. It's actually down below all the moving averages here, so we're going to have, well, there could be a pivot here. There's, as you see there, same ballpark back in September we saw the price pivot at. But as far as the daily chart's concerned, I think we're going to have to look at like Fibonacci retracement levels or some of the other technical indicators to get a better idea how far down we can go before we start finding good support. Not like I have any problem at all with the price continuing down a little further. Let's take a look at the weekly though. Alright, we have previous pivot activity right there back in July at around the current level. Yeah, right around there. Yeah, right around the top there. Didn't really have much pivoting going on there in November, going into the beginning of the year, though. Now looking at the moving averages, though, we did break back down below the 100-week average there. That's a good sign there. We do want to see the price come back down. Again, that'll help with the inflation problem. It might also help with foreign demand for U.S. goods and services, because they, the prices they pay are, and they're buying a lot of American oil now because of the Russia versus Ukraine situation there. 200-week average is down at 64.81. So will we make it all the way down to 64 and maybe see fuel and gas prices continue down on the diesel side into the $4 range? Like upper fours. That would be great to see. I don't know. We'll see. All right, and looking at the dollar index, this is we can link this to expected foreign demand for U.S. goods and services, and we can also use this to gauge what the market sentiment is as far as inflation picture is concerned. As inflation weakens, usually we can expect the dollar index value to drop. And when inflation was increasing, expect the dollar index to also increase in value. It seems to be on a downtrend still. We could get some support down here at the 200-day average though, which is at 105.1. Current price, it's not showing there, but close was 106.062. It looks like right here is where I'm looking. You can see it right there as well, just maybe not it's quite as easy to read. So can we get a continuation of this downtrend? That'd be great. It'll help with the inflation problem with foreign countries, and because a lot of foreign countries are seeing the same problems we're seeing with inflation and slowing down of their economies because of inflation. So we want to see a little bit more stimulation there, or not not destimulate demand. We want to just resolve the supply issues and leave the demand where it's at. And looking at the weekly, we talked about a couple weeks ago this huge drop there when the inflation data came out better than expected. Last week, the producer price index came out better than expected as well, and better than expected producer price data, or wholesale inflation, as we might call it, should lead toward continuing better consumer inflation as well. Do have a bit of a downtrend here now. We can find support here at the 100-week average at 103.516. So it's down a little lower than what the 200-day was on the previous chart. Okay, so we're gonna end this one without the green screen. I'll show you the background here. All right, that wraps up this week's weekly report. Hope you got a lot of good information or education of some sort out of this. All right, as I mentioned again, next week, or actually tomorrow, Sunday, probably end up seeing an interview with me on Jerry and Conan from Grow My Thrift Savings Plan on their webpage, or on their Facebook group and page, whatever, wherever else they have it posted, or they'll have it posted to. He did say something about posting it this weekend, so so watch for that then. And all right, so next week, I said there's a lot of data to cover. I hope I won't make it too long for you, but again, we've got the bookmarks. Just get through the stuff just use the bookmarks to help you get through the stuff that you might have, that you might want to skip past or whatever. All right, so I put that in there to really help you guys get through there, unless you really want to watch all the stuff and learn everything you can. All right, so that said, you all have a great weekend. I hope you all enjoyed your Thanksgiving, and we'll see you next week.